Hello, everyone, and welcome to Financial Accounting. Today, we're going to look at direct and indirect methods of reporting operating cash flows. If you haven't had a chance to watch the video statement of cash flows, I am posting the link right here and also in the description to this video. There are two acceptable formats for preparing the cash flows from operating activities: the direct method and the indirect method. While each method uses a different format to arrive at net cash provided or used by operating activities, the end result is the same. In other words, they use a different path to arrive at the same answer. For both direct and indirect methods, we need to adjust the effects of the use of accrual accounting to determine cash flows. Under the direct method, we need to calculate cash receipts and cash disbursements from operating activities. The difference is net cash flows from operating activities. The statement of cash flows prepared using the direct method is a condensed statement. It requires an additional schedule to show the reconciliation of net income to net cash from operating activities. Under the indirect method, we start with net income and convert it to net cash flows from operating activities by eliminating the effects of income statement transactions that don't result in an increase or decrease in cash. It is a preferred method as it provides more details, and most companies use this method. Under either method, companies must prepare and report information from the indirect or reconciliation method. The reconciliation process is very complex, and you may want to save this list of additions and deductions for your future reference. While it is important to understand the process, referring to the list of adjustments might save you a significant amount of time. All these adjustments to net income are necessary to arrive at net cash provided or used in operating activities. Notice that the adjustment process requires us to add back any non-operating losses and deduct any non-operating gains included in net income. The full cash effect of the transaction resulting in the gain or loss is presented as an investing or financing activities in the statement of cash flows. For example, the sale of a building is presented as an investing activity. The retirement of debt is presented as a financing activity. Let's look at the direct method first. The direct method takes accrued basis revenue and adjusts it for changes in accounts receivable to arrive at cash received from customers. If accounts receivable decreases during the year, the decrease is added to the accrual basis revenue. A decrease in accounts receivable means that customer cash payments on account exceeded customer changes on account during the period. This excess is used to adjust the accrual-based revenue reported on the income statement to report the total cash received from customers during the period. If accounts receivable increases during the year, this increase is subtracted from revenue. An increase in accounts receivable means that customer charges on account exceeded customer cash payments on account during the period. This excess is used to adjust the accrual-based revenues reported on the income statement to report the total cash received from customers during the period. Let's look at an example. Net sales are $22,000 and the change in accounts receivable during the months is a $12,000 increase. What is cash received from customers? By adjusting net sales for the increase in accounts receivable, cash received from customers is calculated as $10,000. Now let's look at T accounts, as using T accounts might make it easier to understand why the increase in accounts receivable needs to be removed from net sales. Assume we have 4 transactions during the month, 3 sales and 1 payment. First, we sell 10,000 on account. This transaction is recorded as an increase in accounts receivable and an increase in sales. Remember that assets are increased by debit and revenues are increased by credit. The second transaction is a 5,000 sale on account, and the third is a 7,000 sale on account. Assume that only the first invoice was paid in full during the month. This payment increased cash by 10,000 and decreased accounts receivable by 10,000. As a result, we have an increase in sales of 22,000 and an increase in accounts receivable of 12,000, which is 22,000 minus 10,000. As you can see from this example, the total sales is 22,000. However, we only received 10,000 in cash. Accrual basis revenue accounts, such as interest revenue and dividends revenue, need to be adjusted for increases or decreases in the related receivable account. These computations are very similar to the revenue example on the previous slides. To determine cash paid for merchandise, complete 2 steps. First, adjust accrual basis cost of goods sold for the increase or decrease in inventory to arrive at purchases. Then adjust purchases for the increase or decrease in accounts payable. Let's look at an example. All accrual basis expenses need to be adjusted for changes in related prepaid asset accounts and accrued liability accounts. This is Martin's balance sheet. The first step is to calculate the changes in these asset accounts during the year. The second step is to calculate the changes in the liabilities and equity accounts. Here is Martin's income statement for the period. We will use the numbers reported in the income statement in our calculation as well. To limit any assumptions we make about the cash flows during the period, we need to gather additional information. Let's review the additional information gathered. Trading securities were purchased during 2019 at the cost of 25,000. Equipment with a book value of 40,000 was sold during the year for 43,000. Equipment with a book value of 30,000 was destroyed during a flood in 2019. There was no insurance. Martin owes 25% of the common stock of another company and uses the equity method to account for this investment. Martin's tax rate is 40%. The notes payable to the bank carry a 12% rate. The payments are due on the first day of each month. The bonds payable carry a 9% rate. Interest is payable semi-annually on July 1st and January 1st. Martin sold stock during 2019 for $50,000. Martin received $10,000 dividends from its equity investment. Now let's start working on the statement of cash flows. Let's first work through calculations for cash received from customers and cash paid to employees. Sales revenue and salary expense amounts can be found on the income statement. Accounts receivable and salary payable amounts can be found on the balance sheet. To calculate the cash received from customers, we need to subtract 8,000 increase in accounts receivable from sales revenue of $800,000. Cash received from customers is $792,000. Cash paid to employees is $82,000, which is an $80,000 salary expense, plus a decrease in salary payable of $2,000. Next, calculate cash paid for inventory and cash paid for interest. To calculate cash paid for inventory, start with the cost of goods sold, add a decrease in accounts payable, and subtract a decrease in inventory. To calculate cash paid for interest, begin with interest expense and add a decrease in interest payable. The next step is to calculate cash paid for taxes. To do so, start with the income tax expense and add a decrease in taxes payable. Also listed on this slide are some other operating cash flow items. Remember that we have to go through all accounts that affect cash. Now let's put together the operating section of the statement of cash flows. The operating activities section on the statement of cash flows for Martin Company would look like this. Remember that the goal is to convert all accrual basis account balances to cash basis. Cash provided from operating activities totaled $27,370 compared to reported net income of $41,970. Let's look at the completed statement of cash flows. The operating cash flows amount is $27,370 as we just calculated on the previous slide. The investing section includes only the cash inflow of $43,000 from the sale of equipment. The financing section includes cash from the sale of stock as well as the cash outflow of $100,000 for payment on the principal of bonds. The financing section also includes the cash outflow of $10,000 for payment on the principal of a note payable. Notice that the ending cash balance on the statement of cash flows agrees with the ending cash balance reported on the balance sheet. There are two major categories of reconciling items. They include adjustments for non-cash expenses and timing differences. Depreciation, depletion, and amortization expenses are examples of non-cash expense items. They are added to net income to arrive at net cash flows from operating items. Timing differences include changes in assets and liability accounts, such as accounts receivable, inventory, prepaid expenses, accounts payable, and accrued expenses payable. Most companies use the indirect method, so let's look at how to prepare the operating section of the statement of cash flows using this method. The indirect method starts with accrual-based net income and makes certain adjustments to arrive at cash flows from operating activities. Adjustments to accrual-based net income include adding back any non-cash items that were included to arrive at net income, such as depreciation and amortization. Remember that depreciation and amortization expenses reduce net income. Since these items are not cash items, they should not be included in the statement of cash flows. Gains and losses are other items on the income statement to consider. They result from the sale of an asset. Gains are added and losses are subtracted on the income statement to arrive at net income. Since gains and losses don't represent operating cash flows, gains are canceled out by subtracting and losses are canceled out by adding to net income in the operating section. Appropriate adjustments should also be made on the income statement to reflect the change from accrual-based revenue to cash-based revenue. This is done by analyzing the changes in non-cash current assets and current liabilities. This is another useful tool to help with preparing the statement of cash flows. This chart explains how to treat a change in a non-cash current asset or current liability in the operating section of the statement of cash flows. Let's begin with current assets. If accounts receivable, a current asset, decreases during the year, this decrease is added to net income. A decrease in accounts receivable means that customer cash payments on account exceeded customer charges on account during the period. This excess of payments over charges is used to adjust the accrual-based revenues reported on the income statement to report the total cash received from customers during the period. Likewise, if accounts receivable increased during the year, this increase would be subtracted from net income. An increase in accounts receivable means that customer charges on account exceeded customer cash receipts on account during the period. This excess of charges over cash receipts is used to adjust the accrual-based revenue reported on the income statement to report the total cash received from customers during the period. Now let's look at how to treat changes in current liabilities. If salaries payable, a current liability, decreased during the year, this decrease would be subtracted from net income. A decrease in salaries payable means that the company paid more in salaries than it charged during the period. This excess of cash payments over charges is used to adjust the accrual-based expense reported on the income statement to report the total cash paid for salaries during the period. Likewise, if salaries payable increased during the year, this increase would be added to net income. An increase in salaries payable means the company charged more than it paid during the period. This excess of charges over cash payments is used to adjust the accrual-based expense reported on the income statement to report the total cash paid for salaries during the period. Let's take another look at the detailed list of the adjustments to net income to arrive at net cash provided or used in operating activities. Unlike the direct method, the indirect method requires that the net income and all adjustments to net income are listed in the operating section of the statement of cash flows. As I already mentioned, the end result is the same. The difference is in the approach of how to arrive at the net cash provided by operating activities. That's all for today. Thank you for watching this video. Don't forget to like and subscribe, and click on the notification bell so you don't miss future videos. I will see you soon.